These banks are next. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, more bank failures are imminent as a liquidity crisis spreads to the banking system. And I'm going to show you which banks are under attack and next in line for potential failure. But before we get to that, I want to dig deeper into the Silicon Valley story and try to find out exactly mistakes that they made and to see if those are going to filter across into these other banks. And I think the answer is going to surprise you. We also want to discuss how it is at the very highest level of the government and the Federal Reserve that they're the ones that are causing this crisis in the banking system. We're going to talk about the mistakes they're making, what their likely policy response to this will be, and why I think their response will be widely ineffective, on top of the fact they're going to deny the entire thing. And we've got a story from the very top of Silicon Valley from the CEO that will completely shock you and perhaps set up that something on the inside was cooking before they failed. Let's over to Bloomberg, where we picked today's story up with a headline. Silicon Valley CEO sold a whopping $3.6 billion in stocks days before the bank's failure. And I want you to keep in mind, just days ago, he was out trying to raise capital. And yet, how will this look? How is it going to look as the world finds out that when he was making calls for cash to get money and sell stock, he was busy unloading his? Silicon Valley Bank CEO Greg Becker sold 3.6 million shares of company stocks under a trading plan less than 2 weeks before the firm disclosed extensive losses leading to its failure. And while Becker may not have anticipated the bank run on January 26, which would be unlikely that he did when he adopted the plan, the capital raise is material. If they were in discussion for a capital raise at the time the plan was adopted, that's highly problematic because it looks like he's trading based on inside information. I'd love to know, what do you think? Do you think he knew what was going on and wanted to get out before it was too late? Or was he just a victim, as many of the other depositors and shareholders were at Silicon Valley? Now let's get into the real question that we all want to know is who's next and how many banks could be at risk? This from Zero Hedge. Was Silicon Valley Bank really unique? And who's next? And perhaps the most unique feature, as we touched on earlier, is the bank security exposure. Now, we talked about this in yesterday's show. Of the bank's total $212 billion in assets, $120 billion of them are securities, of which most, or $57.7 billion, are in what is called to hold to maturity. See, there's two issues here. So in yesterday's show, we discussed about how there's all these unrealized losses from this aggressive Fed hiking cycle when the banks were just beneficiaries of just massive amounts of money. They had to back them with assets. They bought very low yielding treasury securities. The Fed then goes on an aggressive hiking cycle, of course, and now we see those securities have major unrealized losses, but that isn't the case for all of them because there's this thing called hold to maturity, which helps banks such as Silicon Valley turn those unrealized losses, well, into absolutely nothing. So let's head over to Investopedia. So let's address the question of what is a hold to maturity. Is unlike held for trading securities, it's a temporary price change for hold to maturity securities that do not appear in corporate accounting statements. So think about it this way, is let's say you bought a stock, for example, and you could designate it, which you can't do, hold to maturity, and the stock went down. Well, you don't show any unrealized loss on your books, which would be very interesting. And of course, this is exactly what the banks are able to do. But there's a trade-off. The appeal of HTM securities depends on several factors, including whether or not the purchaser can afford to hold the investment until it matures, or if there might be an anticipated need to sell before that time. So you look at what's happening here, and in order to avoid unrealized losses, a bank can say, look, we'll classify this as hold to maturity, which means exactly what it says. You must hold it to maturity. Now, what happened at Silicon Valley is they ran into a cash crunch because depositors were leaving. And what would be the logical thing you would need to do? Sell some securities. What their problem was is they had maybe too many of them in this hold to maturity that they couldn't actually sell. And so, of course, the CEO needed to go out and sell a bunch of stock and try to raise capital and just ran out of time before money hit the door. And while all U.S. banks parked some of their money in treasuries and other bonds that dropped in value last year, thanks to the Fed's fastest rate hiking campaign since Volcker, Silicon Valley took it to an entirely new level as their investment portfolio swelled to 57% of its total assets. And according to the next chart, no other competitor among the 74 major U.S. banks had more than 42%. So this kind of sets up kind of the initial thought that perhaps what really happened at Silicon Valley was just a poor management of their portfolio. They got hit with a downturn in tech stocks, money started flowing out, and they were just turned out to potentially be in the wrong place at the wrong time. But maybe that isn't the entire story. Let's take a look at this chart again, this one from Zero Hedge and Jefferies. And what we can note now is looking at these different companies, these different banks, these are shown in their symbol, their ticker. We see that there's 4 other banks right under Silicon Valley that have a weighting now of 41 to 42% of their securities as a percentage of their total earnings assets. Does that mean that these are the banks that are at risk next? Well, the answer, which may surprise you, is no. That actually doesn't mean they're at risk at all. And perhaps the biggest irony in the Silicon Valley failure is that while higher rates are in theory good for banks, and again, this all stems back to the notion of if banks have higher rates, they can lend money out at a higher rate, and they capture a bigger spread of that, and so it's a great deal. But as we talked about in yesterday's show, look, the problem is they had all this money flowing in. They didn't have people borrowing it because they didn't need to borrow money. There was so much money being dumped in the economy by the government, there was no need to borrow, so they had to go out and buy these securities, and those securities are now upside down, again, courtesy of the Fed. I want you to think about the 2 major players here, the U.S. Treasury, who issued all these longer term notes and bonds when they could have just issued a massive amount of T-bills and left it that way. And then you have the Fed that turns around and says, hey, you know what? We got to hike rates to the moon here because, well, we've got to deal with inflation. And while we don't have the tools to do that, well, what we can do is make interest rates go up and cause the banking system to hemorrhage. What we just observed is how catastrophic higher rates can be for banks that have locked in the wrong asset structure. We showed this earlier by charting their net unrealized losses that soared to $16 billion in 2022. And here you can see Silicon Valley's unrealized losses, a whopping, again, $16 billion. Now, the question you may be wondering is, well, how does this fare up with the major 4 banks, which is a good question because are they at risk? Well, my answer is not so much because they, on the other side of the story, unlike Silicon Valley, the big banks, at least right now, according to what they're telling us, they have too much cash. But unrealized losses, well, they got a bunch of those too. And here you can see, but they're still pale in comparison. You're looking at roughly JP Morgan, $36.6 billion, Citibank, $25 billion, Wells Fargo, $41.5 billion, B of A looking like the best one with hardly any unrealized losses. And again, you think about Silicon Valley at $16 billion. Well, they had some major losses just compared to the big 4. You'd think the big 4 would be way off the charts, but still, right now, those numbers aren't a reason to panic. The question will be is when the downturn happens and when, of course, we see a lot of delinquencies and defaults. Will that be a problem? Well, that will be a story for another day. And all the people who have been around the banking system would say higher rates and sort of a stable environment is good for banks in the long run. But getting there could be painful, and it shouldn't be painful. This is why, if you've ever wondered, why does the Federal Reserve in the past gradually raise rates over a long period of time? It's called an adjustment period, and it gives the banks and everybody else in the economy time to adjust to these rates, adjust their portfolios, and do what they need to do to avoid the situation we're in right now. And so, of course, as we look forward to the next Fed meeting later this month, it now puts the question is, if Powell comes out with another 50 basis point hike, what's that going to do to all the other banks that perhaps are not in the situation that Silicon Valley is, but maybe close, that could push them over the edge? And what we can see here, and warning the country's 20th largest bank would consider a sale of available for sale securities if the deal was economically positive. Of course, this from Key Corp, and saying that, look, if we may need to sell and we may have to, but let's talk about what's going on now at the government level, because again, I want you to see that the policy mistakes started at the top, and this wasn't something that came up yesterday. We can now go back a couple years to the pandemic and see the mistakes that were being made then are causing the problems we have today, and the fix isn't easy at all. Treasury Secretary Yellen says the Treasury is monitoring a few banks amid the fallout. Of course, she'll say, as we can expect, this isn't a big deal, but you mentioned Silicon Valley Bank. There are recent developments that concern a few banks that I'm monitoring very carefully, she said. And asked if she was concerned about anything. Well, of course, we know she's not concerned at all. But even going to the top of the White House, we see the economic advisor Barrett. He said that the White House is monitoring the Silicon Valley situation very carefully. Well, not monitoring anymore. They're under, and I don't want to say any more than right now, but I want to assure the viewers that this is something we are on top of, while adding this is a highly fluid situation. Well, I'll add to the story, there's really nothing the White House can do here. But going back now, let's address, of course, the Treasury. What was a mistake that they made is not anticipating this aggressive federal rate hiking cycle. So what they could be doing right now is, instead of issuing longer term notes and bonds, they could reduce their issuance of that and put more bills out into the market and give these banks some sort of relief valve to say, hey, look, maybe we can get out of this situation by getting some liquid cash here to meet redemptions. But no, what do we continue to do is issue a lot of longer term debt, which then will turn to the Fed having to clean up that mess, the one that we know that they've started. And the Fed's having a closed-door meeting on Monday, March 13th. And before you think this is an emergency meeting that they're talking about the discount rate, just so you know, this is a recurring issue. They do have closed-door meetings, so it is nothing to panic about. It was actually put on the schedule days ahead of time, had nothing to do with Silicon Valley, although we can only believe they're going to talk about that. But we look at what the Fed can do. Potentially, they can do an Operation Twist here where they swap, notes and bonds for T-bills. What is the problem with that? Well, the Fed doesn't have the balance sheet capacity to bail out the entire banking system. What they would need is the Treasury to issue a massive number of bills. The Fed would then have to come in and buy it and then run the twist to take the pressure off these banks somehow, some way. The other alternative is the Fed loans the securities to the banks through overnight repurchase or overnight transactions like they do with the overnight repurchase agreements, and do it in the reverse fashion, taking those securities off the bank's balance sheet and giving them liquid cash. The question is, the banks would still have to pay it back. So we have a real conundrum here that is going to be a huge problem. I think the Fed's initial attempt to fix this when the crisis hits will fail, because even if they go out and do a bunch of quantitative easing, it isn't going to fix the issue that the banks have these unrealized losses. Somehow the Fed's going to have to make them go away, and the answer will be drive rates down to zero, and maybe, if you can, even negative. In retrospect, he had zero additional capacity, and this is referring to Silicon Valley, and now the market will actively seek and find out which other small and not so small banks are likely wrong, as we're going to address who is next. And those wondering, they published a note from Goldman's trading desk revealing which banks were being shorted by the bank's top hedge fund clients. And boy, if we know there's any group that has a lot of time and money to do research, it's the hedge funds. They're going short, and here are the 5 banks that they're targeting in no particular order. Number 1, they're after is Signature Bank, internet banking and brokerage firm. They're also after First Republic, heavy shorting going on in these banks. How about Zions Bank Corporation, Key Bank? Remember, they said we're looking to sell if we need to. Well, they may have to if the hedge funds get their way. And Truist, they're on the list as well. Those are on Goldman's top banks that are being shorted by hedge funds right now. And of course, we can expect that this is only beginning. As I said before, what happened in Silicon Valley was only the beginning. And when we wait until you see when the economy is in a full-blown recession, you're going to see the Treasury panic, you're going to see the Fed panic. And this time, I don't think they have the answer short of driving rates down to zero, including all the way on the long end, because that's the only way to get these banks back in a position where those unrealized losses are A-OK and depositors are willing to accept nothing for their deposit. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.